Welcome back to the Retire with Confidence podcast. As always, I am your host, Dave Zaegel, and today's episode is brought to you by CWOs for Hire, which is the financial planning firm that I co-own. We focus on retirement and tax planning, and we are going to start accepting new clients again in the April timeframe. We're paused for now just because we're in the middle of crazy tax and client planning season. But if you're looking for help, you are still more than welcome to get on our calendar. We're still happy to help. We just have to wait a little while until this season of the year gets past and we can start helping new clients again in the month of April. So we are in our second of three videos where we are going over some life insurance planning in retirement. In the last episode, we talked about different types of plans, why they exist and how they work in terms of term insurance and whole life insurance and universal life insurance and all the different benefits and drawbacks and some of the variations that are in those policies. So if you want that introduction and you haven't listened to that episode yet, please do so because that will be helpful for this episode and then also the next one, where in the next episode we will talk about life insurance for estate planning purposes. So why would we need to plan for life insurance in retirement? Because as we mentioned on the previous episode, there may or may not be income to protect for these years. If you are 60 or 65 and you're at the point where you could retire now if you want to, but you've continued to keep working for whatever reason, whether that's just because you enjoy it or you just want to build up more income, whatever the reason is, if you're in a position where you could retire now, well, then you might not necessarily have income to protect versus if you're, say, 50 years old and or 55 and you still have 10 to 15 to 20 years where you need to be working. Well, you absolutely have income to protect and you need that life insurance. But if you're in a situation where you don't need to protect your income anymore because you are set for retirement, even if you retired today, why might we want to still have life insurance in retirement? There are two main reasons that we have seen firsthand. One is if you have health issues. So if you have an existing insurance policy and you have some health issues, it might make some sense to keep it. Now, you're not going to be able to get a new one if you have health issues, but if you have something that's existing, if you have an existing policy and you're thinking, my health's not that great, my longevity is uncertain, things like that, well, then it might make sense to just continue paying the life insurance premium payments over time, because if you did pass away, that could provide a huge benefit to your spouse, to your children, to a charity, wherever you're leaving the money. That could be a huge chunk of money from that life insurance payout that's going out to somebody else, to where it makes a ton of sense to continue making the premium payments if you have some major health issue that you are worried about. So that's number one reason why you might want to keep a life insurance policy in retirement. The other one gets a little bit more, not creative, but advantageous from a retirement planning perspective. And this instance is where we have something like an annuity or pension payout. So we have this discussion all the time with people with pensions, where in a pension, and also if you're getting an annuity, or if you have an existing annuity, but we'll talk about pensions more specifically because we see this very commonly, is people are trying to figure out what pension payout they want to take. Because your employer or whoever you had the pension from is going to give you a sheet of paper or multiple pages of paper that will tell you what your payout options are. You can do a single life, meaning that when you pass away, the pension payment stops. You could do a joint life, meaning that as long as one of you is alive, you're getting this pension payment. And you have a whole bunch of options in between typically. You could do it to where it's 100% while you're alive and 75% for your spouse, or 100% while you're alive and 50% for your spouse. So you're going to see variations and different payout amounts based on those. Obviously, or maybe it's not obvious, but I'll state it anyway, the higher payout is going to be on a single life, because that insurance company that's providing the pension benefit knows that It's only based on one life. So when you pass away, they don't have to pay it out anymore. Whereas if there's a second person on there, if it's a joint payout, that's going to be the smallest payout to you because they know that even if you pass away, it's still going to get paid out to somebody else if they are still alive. So there's going to be a difference in the benefit payments, with the highest payout being on a single life, the lowest paying out being on a joint life. And then again, there's a lot of in betweens in terms of the percentages that can be paid out to your spouse or whoever else is the beneficiary, could be the beneficiary of that pension payment. So, where life insurance comes into play with this is that you can look at the difference between the pension payouts and think, well, could I use that difference in pension payout to purchase a life insurance policy with that extra money from the premiums? So I'll give an example here because I think that'll help make this a little bit more clear. Let's say that in your pension, you are going to get $4,000 a month if you take a single life payout. Or if you did a joint life payout, you get $3,500. So there's a $500 difference there. 4,000 if it's just on your life, 3,500 if it's you and your spouse. So you've got $500 to play with here. Well, what if you say, well, let's look at the single life payout that gets me the $4,000. Oh, gee, but I'm worried about what happens if I pass away, then my spouse doesn't get anything. Okay, well, this is where life insurance can come in. You're getting an extra $500 for just doing it on your life. Could we look at a life insurance policy and say, well, what does a $500 premium payment get me? In doing so, you're able to take that $4,000 a month, that $500 more than you would under a joint payout. You're getting that $500. What if you could take that $500 extra, buy a life insurance policy? That way, if you do pass away, you get your spouse gets a big chunk of money from the life insurance policy to then replace that lost income. It's a matter of evaluating what that payout is. What is that death benefit that you would receive? Would that truly replace the income lost from that pension payout if you pass away and that single life payout goes away? This is where we can be advantageous in the planning. Sometimes it's going to work, sometimes it's not. It definitely depends on your health because that's what they're going to base the life insurance policy on. So for some people, this is absolutely a no-go. If their health's not in a great condition, then yeah, they're not going to get a life insurance policy that's going to be affordable enough to then have a death benefit that's going to replace that income. On the other hand, if you don't have health issues, you might very well be able to get a life insurance policy that gets maybe even bigger premium, or excuse me, bigger death benefit payout than you need to cover that income. So you can really take advantage of the thought that you can take a single life payout on the pension plan, and if you do have a very long retirement, so you live a long time, you are getting that higher payout. Now you're making a premium payment to the insurance company. Remember, you had that $500 difference because you're getting $500 more in this example for a single life payout. You're maybe giving most or all of that to the insurance company in premium payments. So net, you might still get the $3,500. But if you live a long time, you're getting that payout for a long time. And then on top of that, the death benefit kicks in and goes to your spouse or your dependents whenever you pass away. So especially if you are in good health and you have a situation like this, you might want to take that single life pension payout, get the benefit of that payout for a long time, and then on the top of it have this tax-free death benefit so that when you die, that can also get paid out to your spouse or your beneficiaries. So again, it's just, there's not a right or wrong answer to this, but it's something that absolutely should be evaluated. You need to be able to say, okay, what's the difference in the different payout levels? And your brain should think, okay, am I in good health? What kind of life insurance policy can I get? and go get some quotes, get an evaluation done to say, what policy could I get? What would the death benefit be? Could that cover the lost income? And even better, if I'm in good health and live for a long time, I can double dip here. I can get the pension payout while I'm alive, and then my spouse or beneficiaries can get the tax-free life insurance death benefit after I pass away. So that's a great planning tool. If you have annuities or pension payouts that you're trying to evaluate, you might be able to tap into a life insurance coverage that would pay out at your death and also would cover income in case you happen to pass away early. Great planning tip. We love this. We love to at least have the evaluation. It doesn't always work out. That's okay. Then at least you know. But it's a great planning opportunity for people to look at and say, how could I take advantage of using a life insurance policy with this annuity or pension that we are going to get to maximize our potential payout in the long term?